All right, friends, I have added a couple of slides to the presentation, to your notes, and I'm going to call this section Clip 1A. By doing this, I don't have to renumber everything that I've already done for Chapter 1. So we talked about economic systems, the economic systems of capitalism, socialism, and communism. And I want to distinguish between economic systems and a political system. So with political systems, these are ways that countries determine who will make the laws for the population. And so I think I've already made the point in a previous slide that the political system comes first. Once the political system is agreed upon, either through a consensus of input from the population or through some type of terrorism or military might, depending on whether you're talking about communism, socialism, or capitalism. So once the political system is established, then the political system, they structure the economic system. They make the rules. The political folks make the rules for the economic system. So let's talk a little bit more about capitalism. And so in capitalism, individuals who own wealth and financial institutions that hold wealth for individuals, and these financial institutions would include banks, pension funds, mutual funds, and insurance companies. Okay? So individuals and financial institutions allocate capital. They invest capital based on the returns anticipated from the investments. So it is returns that drive investment and drive capital allocation in capitalism. That's why we call it capitalist system. Okay? Therefore, in a capitalist system, loyalty is owed first to the owners of the businesses, the people who have the ideas, the people who provide the equity capital. They are owed loyalty first from their businesses. But there are other stakeholders in businesses, and these stakeholders include the employees, okay, customers, suppliers, and other members of the community who are affected by these businesses. Okay, there may be ancillary businesses, suppliers that are affected by the business, restaurants, hotels, you name it, other businesses that are impacted by a big employer. They are stakeholders in businesses. All right, so let's take a little closer look at returns. So returns is equal to cash flow or profit, and cash flow can be income from the project and or the gain on the sale of the assets. So ideally, when you invest in a business, the business operates, generates a profit and positive cash flow for a period of time, and then at some point, you, the owner, sell the business for a nice chunk of cash, and that adds to your return. So you then take the cash flow and divide it into the dollar amount that was put into the investment. And so you get a sense of how much cash flow you generate and how much cash it took to get the business started and to keep the business operating. And that is what your return is, when you divide your cash flow from operations and from the sale of the business into the amount of cash that you had to put in. That's the return. So for a business to survive, its return must exceed its cost of capital. There's a cost of capital, and the cost of capital is interest on debt, and the cost of capital is dividends and giving up your ownership in your company on equity. Okay? Other items that impact the return an investor should expect to receive from a business include a premium return for excessive risk, and we're going to develop these ideas more fully as we go through the semester. The time that your money is tied up. The longer your money is tied up, the higher your return needs to be. And inflation. So if you put money in at time 0 and get money out at time 1 or 2 or 3, The question is, will a dollar at the end of the period buy the same amount of products and services as a dollar at the beginning of the period? If it will not, if prices have gone up for products and services during that period of time, that's what we call inflation, and you need to get compensated for inflation. And then lastly, as you determine a return that you would hope to earn on an investment, you look at returns historically that people have earned on similar investments, and that helps shape your expectations. All right, so the amount of money, the total dollar amount of money required for an investment is a practical consideration as you are thinking about starting a business or buying a business or maintaining a business. The amount of money that you need is a practical consideration, but it is not a theoretical consideration when you are using return to drive investment decisions. And that means that a return is taking the cash flow divided into the amount that you need. And so the amount that you need, theoretically, a return is a percentage. So it might be 15% of a million, it might be 15% of 100,000, it might be 15% of 1,000. The 15% return is the determining factor, theoretically, although we know that it is much easier to raise $1,000 than it is to raise $1 million. All right, so let's look at a couple of challenges that we have with capitalism, because capitalism is far from perfect. One challenge that capitalism has is to keep investors focused on long-term versus short-term profit. So we've already said that the way to maximize, the goal of a business is to maximize the current value of the stock. And the way you maximize the current value of the stock is to maximize expected, sustainable, long-term cash flow. Unfortunately, the way our system is set up, at least with Wall Street and with publicly traded stocks, is on a quarterly basis. And investments go up and down wildly sometimes based on quarterly reports, and that is a negative aspect of capitalism. The better we can do focusing on the longer term, 2 years, 3 years, 5 years, 10 years, the better off we'll be in terms of the decisions we make as investors and as businesses that will determine how efficiently we use our resources. All right, another challenge is to require companies to pay a fair share of the cost of externalities. So businesses generate pollution, they require security, there's all sorts of externalities that the public has to jump in on and pay on, and we need companies to make sure they pay their fair share. You learn about that in macroeconomics. Another challenge is to limit the influence investors have on government policymakers. Investors should have some input, but not input to the point that they corrupt our system. Our system needs to be fair and balanced, and so we need to be careful giving too much access and influence to investors. Okay? The major problem that communism and socialism have is the control that a small group of people has on the wealth of a country and on the production that an economy can generate. And so you have to be very careful, because that small group tends to create all kinds of corruption, okay? And the economies tend to be very inefficient in terms of how resources are used, and also how resources, wealth, and income is distributed. Therefore, it is very difficult to keep citizens ambitious and energized. Typically, in socialism, and particularly in communism, you have a tiny group of people who are mega wealthy, and then everybody else. And you have a small middle class, typically with socialism and communism. And so what you really want is more fair distribution of labor, production, income, and wealth. And this is an issue that has some problems. We have problems with this in capitalism as well. And you hear a lot of politicians talk about the income inequality. And the question is, how do we solve that? How do we best solve that? Do we best solve that through government? And the answer to that is no. That is socialism and communism, and it does not work. It makes it worse. We need to accentuate and amplify competition and the free sharing of information, okay, in order for our system to become more fair and more efficient. Okay, so you'll see some questions in homework that cover these 3 slides that I just covered, and I'll call it Clip 1A. Until then, that's it. Peace out. Shalom. What's up?